please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
We have Sanjay Dutt, Director of Quantum Securities, now joining us on the phone line. Sanjay, hi, good afternoon. Thanks a lot for talking to us. I think you've had a bit of a break from television, so good to have you back.
Thank you, Anuj.
Your thoughts on the kind of move that's played out, specifically in financials?
This was kind of waiting to happen, and what has really struck us right now is this, unholy trinity kind of thing that's playing out. Combination of the EM currency route that's happening, along with oil that really hurts us at the wrong places, and then added to it the uncertainty that is there in the financial markets in terms of honoring commitments, like we had this ILFS incident, and obviously the fear factor that set in what NBFCs, CPs, etc., and also other liquidity issues, whether they would be honored or not. So combination of these three factors is really what is playing out. So which obviously answers your question as to what happens to financials in most of these companies. I think anything that's straight at this point of time in terms of valuation is obviously susceptible to profit booking and correction, and would be a perfect target to build short positions on, and that's exactly what's happening in the last few days. But I think towards the end of the day, or probably tomorrow sometime, some amount of buying would emerge. May not be in the old names that have been in fancy over the last year or so, the HDFC banks and the Kodaks and those of the business, but maybe in some other names, buying would emerge, which are obviously facing the collateral damage.
Sanjay, afternoon. So, Surabhi here. So, the question is, do you think as and when buyers come back and some confidence returns, is the party really over? I mean, the NBFC party, will there be a clear shift once again back towards banks, or do you think that there is going to be cherry picking in some of these housing finance and consumer finance companies? Would you recommend that?
See, structurally, I don't think anything has gone wrong with this housing finance, the NBFC, and the financial services story in India from a longer-term perspective. It's just that we will see this bout of, correction, overvaluations frenzy, which will go on for 2, 3, 5 years. Whenever you see a structural kind of a run in these sectors, we've seen that we have aggressive period of correction, and we obviously have euphoria coming back in after they get overbought. But I don't think any change in the structural position of this sector or the opportunity that is there in this sector. It's just that new names would emerge now. I don't have any positions, but something that comes to my mind immediately is if one sat down and realistically looked at the IDFC and Capital First combination that's in for a merger, and if you sat down and compared that with the valuation of something like a Bandhan Bank or something like an HDFC, and you would figure out where to put your money. And once again, I don't have any positions in any of these, but I'm just giving you examples that we would have new names where money would start moving in, and then one would suddenly realize after a year or so that these are all sitters. So it's this process that the market goes through, and that is exactly what we are seeing now. Something that gets stretched beyond a point, it has to snap and correct, and then money has to move in somewhere else.
Okay.
So that's exactly what we are seeing. It is that it happens a bit too aggressively in our kind of markets because of various factors that come together, like the trinity I mentioned. That's what is playing out. So I'm not too worried about what's really happening.
Okay. Sanjay, the other big talking point has been Yes Bank. Your thoughts? As we speak, its market cap is actually lower than even Bandhan Bank. Since you raised the topic, you think the market's worried that perhaps some skeletons would come out, or is this actually the best buying opportunity for a franchisee like Yes Bank right now?
See, without really commenting on the asset quality and the fact that I don't know anything about the asset quality, there has been, gossip and talk on the street about the asset quality. I really do not want to comment on it because I'm not privy to anything. Neither have I done a detailed analysis of the portfolio of Yes Bank. But unfortunately, this event has come at such a time when markets were right, particularly the financials were more than ripe for a correction. So this event of the CEO and MD having to step down earlier than expected has kind of perpetuated or kind of magnified the correction in the bank. But I wouldn't be brave enough to venture out and buy Yes Bank at this point of time. I think there are much better propositions that are available in the market at this point of time. I would want the dust to settle down here. I would want to figure out what the succession strategy is, who's going to take over the bank. So let it play out. I won't mind buying it 10-20% higher and more expensive, but at least I'm more sure. If I have to buy something today in a good private bank, which I think has compelling valuation reasons to buy and most negatives have played out, I'd probably buy an ICICI bank, but not a Yes Bank. So that's not a qualitative judgment on Yes Bank, but that's because what I feel that the story is yet to play out fully in the entire Yes Bank saga.
Sanjay, finally, a slightly broader question. The emerging market basket fell about 16-17%. We were outperforming because we had a decent first quarter and decent growth numbers, etc. But now with the wheel turning quite swiftly, and we can go on into the number of factors. I mean, there is trade war, there's rupee, there is whatever's happening. Also, by the way, debt market factoring in an RBI rate hike. So I don't know, has the equity market factored that in? Is there a bigger correction that perhaps we are getting in right now?
RBI rate hike? No, equity markets have not factored in right now at this point of time. That would be another kind of setback and shock to the prices. But frankly, I think other than the rate sensitive, there are enough opportunities in the market to look at. There are many sectors where one can put money to work, where there are reasonably good signs of growth ahead in the next few years. So one doesn't necessarily have to focus on financials, which are obviously the first ones which react to rate hikes or any risk that is there in this financial system in terms of defaults or, re-rating of AAA papers, etc., what we are all talking about, rumors, and actually that's happening right now.
Sanjay, we leave it there. Thanks a lot once again for joining us after a bit of a hiatus.